Hello, everyone. Thank you very much for joining us today on this webinar, which is entitled Discover Smart Ways to Save and Invest. My name is Nick Charalambous, and I'm joined by a few of my colleagues, notably Cliona O'Donoghue, who's going to be helping me and assisting with the questions that you may ask during the course of this webinar. And we would encourage everyone, if you can, to make this as interactive as possible. Please feel free to put any questions that you have into the chat function or Q&A, and we'd be more than happy to answer them as we go through this. I'm going to go through this quite promptly, guys. There's a lot to cover, and I want to try and get through it in the next half an hour. We would absolutely encourage you, as I said, to ask questions, and we will address them towards the end. I have an investment background. I studied at the London School of Economics. I've been a financial broker for over 27 years now, and I have a specific interest in investment markets. For those of you not familiar with Alpha Wealth, we're a very progressive company based in Cork with offices in Dublin, and we have over 11 qualified professionals helping people to manage their finances. So the main takeaways from today are talking about the current state of the world, and in terms of where we are, where should you invest? I help you understand about how you can get the most out of your money, how to reduce the tax that you pay. This is really important, tax being the largest expense that we suffer during our lifetimes, especially when we're looking to try and get our money working for us. And then finally, this notion of financial independence. So looking at the world back in 2024, we had an unprecedented year of elections, notably, obviously, in the US. And we had what was termed quite a bit of volatility or movement. And this was in relation to a lot of the, I suppose, impacts of events that took place, particularly with elections, the interest rate climate, which we saw fall in Europe for the first time in many years. But notably, it was an incredibly attractive year for quite a number of asset classes. Now, again, just to surmise, the main things that we took from last year were the notably Magnificent Seven. I'm sure many of you are familiar with this concept of these so-called seven companies, which have typically driven markets quite significantly over the last couple of years. I mentioned about interest rates, the global uncertainty, and notably gold, which is actually quite an unusual asset class to invest in. And I'm going to give you some more information in relation to that later on. So 2024, not to dwell on, but again, commodities did well. Cryptocurrencies, namely Bitcoin being the granddaddy of them, did extremely well, particularly when Donald Trump was elected. The stock markets I've referred to. But interestingly, deposits have fallen, and that can be a concern for anyone who has money in the bank and is looking to obviously get a decent rate of interest from. So the starting point is you need to decide what your financial objectives are and compartmentalize into what I refer to as these three different pots. The first of which is the short term. That's the period in which you need money for the next 3 years, whether you're looking to buy a car in that period, possibly buy a property, or indeed pay for things like family holidays or works you want to do to the home. The medium term, this is what most people probably perceive as being investing. Please do not invest for less than 3 years. Do not buy cryptocurrency just because you want to make a quick buck. Anybody that puts money into any form of investment, in my opinion, should have a minimum term of 3 years. And then the long term is typically that kind of period, that last third of your life, which we refer to as the fun years or the retirement years, if you want to call them that. But that doesn't necessarily mean that you have to retire. It's just being in a position where you can essentially decide whether you do want to work or not. So once you've ascertained that, and if you're wondering why it's so important to get the best returns from your money, this concept of compounding returns that Einstein coined the eighth wonder of the universe. And the graphic on the screen there, for those of you that can see it, this difference of 2% additional interest, whether it be in the bank, whether it be on an investment, whether it be on a return of an asset that you have. You can see quite visibly that over a long period, a sum of monies, and it doesn't matter how much it is, it could be 5,000, it could be €5. The effect of it growing at that extra 2% a year will give you more than 50% of an additional return. It's really, really significant. And I cannot emphasize why it's so important to make sure that your money's working hard for you and that your fees are kept to a minimum. So what are your options? We talk about the fact that there is no one fits all solution. And people often ask me what they should do when they've received a lump sum, whether it be from redundancy, whether it be from the sale of shares, or indeed a sale of a property, inheritance, or a gift. And the key thing that good financial advisors should do is help them understand about this balancing act between leaving money on the short-term needs for their financial goals, paying down debt, certainly not having debt like credit card loans, for example. What type of investments are out there from different aspects of shares, something called ETFs, managed funds, property, pensions. There's a whole plethora of different investment ideas out there. Recently, I've started to see more and more press. These are a few press cuttings that we've taken of what I call this wall of worry. The fear that because stock markets have done well and the fact that Donald Trump is volatile and makes comments that do make market movements and how to actually react to that, people are starting to become a little bit more concerned. Notwithstanding, we look at, I suppose, the things that we can visibly see. And one of those things is that we look at the dollar and its strength at the moment versus, for example, the euro, to a point of which it's almost at parity. And interestingly, I spoke to a client yesterday that had recently just sold shares in their company and was looking at getting the best exchange for their money and looking at the likes of parity for that. Now, again, as independent brokers, we help people in terms of various different areas, including money exchange, and we give independent guidance to. But the key point of this is that this is not necessarily a good thing. This can affect US companies, particularly if they export, which most of them do. The last time we saw the dollar at parity or above, as you can probably see on the graphic there, was back in 2022. And that was a poor year for investment markets, partly because of the performance of some of these so-called large companies, the likes of Apple, for example, that was suffered because of the strength of the dollar. Now,
So
again,
Nick,
there's a lot.
for anyone that has, let's say, shares in Apple or any other US company, is now a good time to sell, or should they hold?
The key, I suppose, point is firstly, what exposure do you have to that company? And most people that I speak to that work for these types of companies have too much exposure. And if they're honest with themselves, they probably know that. People who have done very well in accumulating shares in the likes of Lilly, Apple, Microsoft, Google, whichever company it might be. And yes, these are very, very good companies, but the problem is that they have what I call investment bias. They've accumulated those shares purely because of their employment. And if they were independent and if they were offered the same equivalent money, they wouldn't buy those one share for all of that value. Now, if you are in a position where you are overexposed, and we talk about diversification, which I'll get onto in a moment, the key thing is, yes, arguably by converting those dollars into euros, if you require those funds for other purposes, such as buying a home, paying for an extension, reducing debt, putting more money into your pension scheme, it would be a good time based on the fact that the dollar is quite strong, particularly against the euro. By the way, a lot of people who try to time the market, typically it's near on impossible to do this. I always say to people, try not to try and pick a good time when you should invest. It's all about what they call the time in the market. And what I mean by that is that if you have money available to you, and if you've decided that you have this 3-year plus period that you can invest for, invest today and wait as long as you can. The reason being is that that will give you the ability to have the most probability of success. And obviously that gives you the ability to ride out any short-term movements. And you can see again on the screen there that any stock market crash that we've experienced over the last 100 years typically recovered not just to an all-time high, but normally within 2 years of that crash. Notably, the one exception to that was back in 2008, but it did recover, albeit that it did take that period longer. Now, we're not anywhere near a cycle like 2008. That was a very different period for many different reasons. I've written quite extensively in many press over the last number of years. And whenever I come across people who get information from various sources, and I'm a great advocate for being fully informed. But what I find is that unfortunately, a lot of people get what I call the kind of the canteen financial advice, where they might see something on social media, they may speak to a colleague of theirs, and with the greatest respect to all of those individuals, not all of them are necessarily completely unbiased, and not all of them necessarily have the wherewithal to understand about the various different instruments and get under the bonnet of exactly what makes the most sense for that individual. Case in point are I'm often and almost on a daily basis asked like for share tips. And whilst I have a very strong understanding of the investment world and stock market, this is just a graphic of one that I picked up recently from social media, giving recommendations of how I could get rich quick. And this whole concept of what we call FOMO, the fear of missing out. But the key thing I'd suggest here is that these companies could all perform very well. And yes, they could all perform poorly. But the fact of the matter is that it depends on what your time horizon is, and it depends on what you're really investing in. And I talk about a concept of called core and satellite. And what I mean by that is that you should not invest in individual companies as your core investment strategy. Arguably, as your satellite, which is your smaller component. If somebody wants to dabble around in shares, that's absolutely okay. But it's typically the money that you can afford to lose. Same when it comes to, trying to time. I mentioned earlier, do not try and time the market. This whole concept of buying on the dip that some of you may have heard of. And this is an example of a very good company, Google, which share price has done extremely well over the last couple of years, whereby over recent times, back 2 days ago, its price was valued at $187. It's typically around the same at the moment. But if you look back over the last month and a bit, Google's share price on the 10th of January was $193. It rose on the 4th of February to $207 and fell back then the following day to $190. It's almost impossible to try and time the dip. And if you bought at that dip, you'd be down about 1.7% based on today's price. Now, obviously, over the longer term, that shouldn't be a major concern to you. But then on that basis, why are you trying to time exactly the right day that you should invest in that stock? We're back to the concept of be diversified, don't overexpose yourself to any company, and try not to time the market. ETFs, these are becoming more and more common now. And anyone not familiar with what an ETF is, this is basically just a fund. It's a fancy glorified term for where you're just essentially selecting a fund of some description, whether it be in the US, global, primarily in shares, doesn't have to be, but most of them that are advertised generally are. And I'm often asked, like, what are the best ETFs? Where should I invest? Now, this is just a headline of the most popular ones. I do not have exposure to any of them, and I'm going to explain shortly why to you in a moment. One of the main disadvantages of ETFs is that generally the tax consideration with them is not quite as favorable as you may perceive. They're typically taxed at 41% versus shares, which are 33%. Again, neither of which should be a reason why you should invest in either. The Nasdaq 100, for those of you familiar with markets, this is basically a tech-heavy index. The problem I have with this particular index is, despite the fact it's very high risk, is that 7 of companies that are listed on the screen make up over 50% of the index. Again, we talk about not having enough diversification in a portfolio. So why am I anti-ETFs? I don't mind ETFs, again, back for this satellite approach. But as you can see there on the screen, I think most of you would accept they provide too much company concentration. I've already referred to this earlier. Too much country concentration. The Vanguard S&P 500, if I was offered €1 for every time someone mentioned that, I wouldn't be sitting here today. And yet most people have a large proportion of their investment portfolio in that one index. And again, back to the point, it is primarily made up of the Mag 7. Sectorial or section concentration, where you only have your exposure in 1 or 2 industries. Great when tech's doing so well, But interestingly, when we saw DeepSeek affect share prices of a lot of these AI type companies, particularly NVIDIA, people started to get a little bit worried and realize the exposure that they have. And this is the key thing that I say to people. If you have an investment in an ETF or a fund that distributes dividends, you have to be mindful that these are taxed more heavily. But one of the main things that I say to people is that if you think about your investment approach, most people wouldn't realize, but these funds are typically at least a 6 out of 7 on the risk scale. And whilst people may be accepting of that, it certainly wouldn't be the case for all of their investment portfolio.
Just
And the
on
point
point
that
number 4 there, Nick, is accumulating funds, are they taxed at 41% or is it at 33?
it's typically at 41. There's a lot of confusion around how these types of funds are taxed. And I can say to you all, generally speaking, they are taxed at that higher rate. It's what's known as deemed disposal, where you must pay the tax after 8 years if you've not sold the investment. And generally speaking, they are 41% for the vast majority of them. So anyone that's not familiar with that or thinks that they're 33, respectfully, I would say that you're probably inaccurate. But if you want some more guidance or advice on it, I'm more than happy to share that with you. Cryptocurrencies became the big thing, obviously, a few months ago. Maybe some of the noise that we see only when it's going up, by the way, has slightly subsided. Obviously, reasons for and against, and this is the same for any investment class. Big growth asset, Trump is a big supporter. The problem with cryptocurrency is scams. That's one of the major issues. This whole thing of FOMO, all these people that say they become overnight millionaires. There's a graveyard full of people that have lost significantly in cryptocurrencies. And the key thing is obviously the volatility. Are you going into this on a long-term basis because you don't want to try and make this quick buck that may not present itself? And the key point is about, again, the consideration to tax and are there better instruments out there? Bitcoin, notably, back from its heady high of over $100,000 a few weeks ago, now sitting around 96,000. And it's been unusually quite static in the realm of crypto. Now, some people have done very well at crypto that maybe listen to this call. I am not anti-crypto. I'm saying for the majority of the investors out there, are you making sure that your money is working in other areas for you, such as are you getting the tax relief on your pension? Have you allowed for short-term financial objectives you have? Because if you're invested in Bitcoin to pay for a summer holiday this year, I think that's a really bad strategy, respectfully. Moving on from that, looking at, where should I invest in other assets, for example, property. I come across a lot of people that are looking to get into investment property because of the fact that investment property has performed very well, and obviously rents are still high, and we're going through a housing crisis at the moment. And you can see again some of the pros for that, but there are many cons. My biggest issue with investment in property as an investment, and I again caveat this as a pure investment, there may be other reasons. Anyone who wants to buy a holiday home, I am all for, and I help them in reaching their financial objectives. But if it's purely just to make money, just remember it's an illiquid asset. You need to have a lot of money, and it's not always very easy to sell it very quickly. Back to the fact as well that it's not particularly diversified depending on how much money you have. There can be some unforeseen costs. Obviously, property prices can go down. We've not seen it of late, but trust me, it can happen. And anyone who's old enough to remember 2008, 2009 could testify to that. Rents, we've seen rent rules change, obviously, the fact that there are caps on rents in most parts of the country now, which is unfortunate. It's obviously been a bit of a drag on performance, and that could possibly change, but it could change for the worse. We don't know where we stand, and this is part of the issue I have with property as an investment. It can be subject to a number of different factors, including tenants who may decide not to pay you rent. Gold. It might surprise you to hear that gold has been the best performing asset class over the last 5 years. It outperformed equities last year and is the best performing asset class year to date, up 11%. Now, some people might perceive that as thinking now's a bad time to buy into gold because obviously it's going to fall, the fact it's gone up. But that's not necessarily true. And it's the same for stocks as well. I'm not saying that the stock market will fall. What I'm saying is none of us know. And that is, as true as we can be. The reality is that it will be dictated by a number of factors, and it's the point is, do we have the time? But generally speaking, as advisors, it's always stated that we should have a proportion of our portfolio in gold, more as a defensive mechanism against the volatility of equities. It might surprise you to hear this, but gold is not a particularly safe asset, even though most people might perceive it. It has performed very well. That in itself can tell you that it can be volatile. And we have had periods where gold has fallen. Managed investments. I'm a big advocate for these. Why? Because they provide a diversification that I keep talking about. They don't require any time. A lot of us are time poor when it comes to our investments. Might surprise you to hear this, that despite the fact that I sit behind a desk all day with an economics degree behind me and a lot of experience, I do not have investments in any of these typical shares or ETFs that people keep asking me about. And the main reason for that is that I do not have the time to manage them. I'm too busy in my day job of meeting clients and giving advice to them that I can't keep a mind to what's going on in the States or indeed any markets for that matter. I prefer for my money to be managed by the best, and I qualify this, investment manager at the lowest fees possible. And that's the important consideration. So do watch out for fees. If you've got an investment in any of these types of companies, whether it be Cantor Fitzgerald, Davy, Aviva, Irish Life, Zurich, or whoever, make sure that you're aware of the tax consideration and make sure that you're getting appropriate advice in relation to your investment. And importantly, review it at least once a year. I'm flabbergasted by the fact that I speak to people all the time that have some form of investment and they haven't heard from their investment advisor in over 3, 4, 5 years. And yet over that period, so much has happened. It's incredible. And it really is important to make sure that you're doing that. And on that basis, we set up what we call the Alpha Savings and Investment Club, where we provide access to those people that want some help and guidance in relation to these types of investments that give you exposure to the likes of gold, shares, property, all in one pot. And it's provided on the basis of a lump sum of 5,000 euros upwards and a monthly contribution of 100 euros a month or more. Provides you fantastic flexibility. It provides you information that you can look on yourself actively daily, but also you get the guidance from Alpha Wealth, who man-mark the fund manager. And as an independent broker, it's something that I do extensively for myself and also for my clients. And these are three funds I'm just going to rattle off to you that I believe are best in class. These are all with Zurich. This particular one is a really, really good diversified fund called Prisma 5. You can see there, interestingly, on the risk rate, and even though its name suggests that it should be in the 5 category, the reason it's on the 6 at the moment is that it moved up recently because it's actually performed more than it should have done on the upside. And that in itself creates this additional volatility. But the key thing I want you to take from this is that as a diversified fund, it has annualized over the last 5 and 10 years about 10% per annum. Now, again, watch for fees. We keep fees to a minimum in Alpha Wealth. But is your investment elsewhere providing that return? That's the key question to ask. And again, we give advice to you in relation to all investment funds that are out there. This is another fund that I really like in that suite. Now, this one is slightly more aggressive. It's in the risk category 6 and will remain there, where Zurich invests in up to 50 companies. And they provide information, which is on the right-hand side of the screen there, typically once a month in arrears. Now, anyone that's looking to copy this, it has changed quite significantly since they provided the last update. They should have provided it for the end of January, which they'll be doing shortly. But you can get a sense of the fact that it's not just investing in one particular industry and certainly not one particular geographical sector. Most people on this call who have money in investments are probably overexposed to the US and almost undoubtedly overexposed to tech. And whilst I'm not anti-tech, Zurich had about 28% of their exposure in a fund that they stock pick. But again, you're trying to get the best performance. And for me, this fund, which is annualized around 15% a year over the last 5 years, gives me that peace of mind that they're going to basically be managing it and making adjustments. The final of the trio is a fund in gold in Zurich. They provide a fund, which again, I mentioned earlier, the last 1 year performance, you can see on the screen there, was 33%. It's phenomenal. And in times of volatility, which we experience at the moment, gold typically does very well. So I have currently about 20% of my exposure in gold currently, which is a little bit heavier than usual. Normally it would have been about 10%. Moving on from that, there are three tax efficient investments. So investments is not just about picking a fund and taking advice from Nick and saying, okay, I want to go and invest in this global 5-star 5 fund. It's about getting proper advice about what's the most sensible thing for you. And before I'd even embark on investing, I'd think about what my short-term requirements are. I'd think about, can I invest in a more tax efficient way? And these are three quick, simple concepts that I want to leave with you. One of them is what's known as Section 73. What this is basically a savings account or an investment fund that if you continue saving or investing over an 8-year period, example on the screen there is a notional figure of 5,000, which is 460 euros a month over 8 years, where it's in your name, you have full access and control to that money. It's placed in one of the best investment funds available in the Irish marketplace, which is through a company called Cantor Fitzgerald, providing returns of about 8 to 10% per year. But what I like about it is that if you continue, which you have no obligation to do, by the way, for that 8-year period, you can decide to use some of the money that you've built up with the growth that it's accumulated to help children, if you have kids, pay a gift or inheritance tax that they receive from you. Now that's really important because we, as I suppose advisors, say to clients that we can only gift our children up to 400,000 euros each. Now, if you have one child, it's almost certain that they're going to suffer tax, either at some stage during your life or on your passing. By you leaving them your home, pretty much will do that. If you have 2 or 3 children, again, if you add up the value of your estate between your house, your pension fund that basically will not die with you, other investments, it's quite possible that you may also exceed that. So it's not a bad idea to say to yourself, okay, I'm giving myself the option. And that's the key thing with this. I won't get into too much detail with you now, but we can provide you information. Aviva actually have the best of these plans available in the Irish marketplace. And if you are able to, you can actually just click on the QR code there to get some information on that. But most importantly, if I were you, I'd get advice from a qualified expert. The second tax-back scheme is called the Employment Investment Incentive Scheme. This is something that all high-rate taxpayers should be aware of, where you have the opportunity to invest in a qualifying company. There's about 70 or so each year that look to raise finance in this way. People typically classify these as startups, but any companies that have traded within the last 7 years can qualify. So they're not really that much of a startup, but you need to be very discursive about the types of companies. But the opportunity for you as an investor is that if you had money, let's say 10,000 sitting in the bank idle, and you were able to leave it in investment for 4 to 6 years, you should be aware that you can place your money in one of these companies that you select and get advice from someone on, and that you will get typically 35% back within 12 months from the Irish government, with a view to getting your money and a return after that 4 to 6 year period. And in case anyone asks, is it guaranteed? The short answer is no. The tax back it is, the investment isn't. And the way you would know that is anyone that's telling you that you're going to get 35% back immediately and a gain on your investment would be obviously indicating that. The last of the three is your pension. And I've spoken extensively about why people should look at their pension as an investment, because most of us can access our pensions from the age of 50, particularly if you have pensions from old companies, and you would typically be in receipt of 40% of every contribution you make to your pension scheme, and the pension grows tax-free. I'm not going to dwell too much on that, but again, I've spoken about anyone who's worked in the UK for 3 years or more over the last 30 years should absolutely be in touch with somebody, if not us, about making sure that they're applying for the UK state pension. There is a window that's closing on the 5th of April this year, and it really is important as an opportunity, something that I've done myself, and I provided a webinar to explain to people how to go about doing that in a very simple way. But you might be surprised to know that you don't need maybe as much in your pension as you may perceive. The UK state pension, if you're eligible for it, will be worth typically about 250,000 on average to people. The Irish state pension typically the same, which is payable from the age of 66 onwards. And it's about making sure that you're doing the best in the position that you find yourself. Lastly, short term. I spend every day speaking to people that still have money sitting in the credit union, the banks, and the post office, and they're earning zero interest. And I say to them, there are two simple ways to avoid that. One of them is to take advantage of these online banks that operate where you can get returns on the bottom half of the screen there of around 2.83% with instant access to your money on the government guaranteed banks that are stronger than the Irish banks operating. Typically, most of those institutions are what are known as treble A rated. Raisin Bank, which I'm going to mention in a second, would be my preferred option, but there are other ones I'm sure some of you may have heard of, the likes of Trade Republic, Bunk, Revolut being the daddy of them, but unfortunately has inferior interest rates. But you can still get 1.7% gross interest from Revolut. So even if you're not prepared to look at the other banks, my advice would be put money into Revolut and earn 1.7% rather than leaving it sitting idle, doing nothing in your current bank. And these are completely accessible. Interestingly, for anyone who's saving monthly, if you're saving towards your summer holiday, Christmas, buying a car in the next year or so, you should try and save monthly. And all of us can do so, in my opinion, even if it's just €10 a month. And AIB Bank of Ireland offer you online access to these accounts, paying 3% gross interest. They're really attractive. So I actually like the Irish banks for monthly savings. But for lump sums, my suggestion is look at Raisin Bank. They've been advertising heavily in Ireland. Fantastic institution. I can send you a webinar video that they did 2 weeks ago. I have no bias, by the way. There's no fees involved. And on the screen there, you can see, and it's really, really simple to set up. They'll offer you 2.83% with a bank that you've probably never heard of, but the AAA in brackets tells you it's one of the safest banks in the world. You can put money on a 1-year term deposit. So if you want money in a year's time, my advice is to put it into Blue Oil Bank through Raisin. And you might wonder, why would you put it in at 2.76 when you can get 2.83 in an instant access account? And the answer to that is because interest rates are going to fall more this year from the fall that we saw a few weeks ago. And it's important to try and secure your return now if you're in a position where you can go for the 1-year term. And they offer terms over 3 months, 6 months, 9 months, and so on. So there should be ability for you to put some of that money under their one platform into accounts varying from demand and also what's called term.
And Nick, what about somebody said here that Bank of Ireland offers super saver offers of 3%?
That's the account that I was referring to, but it's only monthly savings. So please make sure you read the terms and conditions. You can only pay between 5 and 2,500 a month to that account, and you have to empty that account every 12 months. If you do not, the interest rate falls to 2%. AIB have an equivalent that allows you to save up to 1,000 a month, but if you do not clear it out after 12 months, the rate falls to 0.25. PTSB have a version of this. Their rate is 2.5. So whichever of those three banks you bank with, set up a regular saver, but they do not accept lump sums. And if you put a lump sum in, you've already broken the rules and terms of it. But even if that's the case, just know that's a variable rate, guys. And we're going to see about 0.75% of further interest rate cuts this year. If you were in a position where you had money in the bank today, and if you require it within the next 24 months, stick it into Raisin and lock it away. Okay, just before we get on to the questions, there's 3 things I just want to mention. My colleague David is doing a webinar on redundancy in the next week, and I would suggest that anyone who hasn't done so, who may be under threat of redundancy, I haven't put the slide up here, but please do go onto the Alpha Wealth website and you'll see all the upcoming webinars, including David's one. David is also doing one on company shares. I've alluded to it earlier, and I come across a lot of people who have shares in just one company. And it's a fantastic webinar that David's doing on Thursday, the 13th of March. It's completely free, and you can register for it on the QR code on the screen or on the Alpha Wealth website. I myself are doing a follow-up webinar on this concept of FIRE. How can you become financially independent at the earliest possible time? And that particular webinar is running on the 27th of March. So lastly, just before we get into the Q&A, we provide a full review service for individuals. We offer two options. One of them we call Core. That's a once-off fee of 199 euros. The other one is called Platinum. That's a fee of 349, which basically involves a little bit more tax planning and consultations with individuals who have earnings of over 100,000 a year or joint earnings of 150,000 or investable assets of over 250,000. Now, again, the services are very similar, guys, and we provide an all-in review for you where we get information for you in advance of the meeting. We provide you the consultation, and any future consultations are all encompassed within that. So if anyone is interested in that, you can, again, go on the QR code onto our website, email myself. My email address is on the screen there, info@alphawealth.e will get me. And obviously you can get booked in for a financial consultation.